Hey there, John Rickkarn here again, your host as always of the Wealth and Freedom Nexus podcast. Here with another podcast on lending, mortgages, and rates with the returning guest, Timothy Hero. As always, be sure to rate, review, and subscribe in your favorite podcast platform, and be sure to follow W Freedom Nexus on all social media profiles shown above. Now, unless you've been living under a rock, you probably noticed that mortgage rates have been increasing, and interest rates on credit cards are going up, as well as just general borrowing costs are more expensive. The Federal Reserve has been on a trend of rising rates, or the Fed funds rates, to combat rising inflation. And like I said, this makes the cost of borrowing money more. Now, like I said, I have a returning guest, Timothy Hero of Timothy Hero Lending. Also talking about what rates and terms and lenders he works with. Myself, actually, just yesterday at the time of this recording, I talked to another lender, and their floor, like absolute rock bottom non QM rate or qualified mortgage rate, was 6.25%. And that was with the buy down of the mortgage rate. In mortgage terms and lending terms, you can actually what's called prepaying points or prepaying to buy down your interest rate. And a lot of times this just comes down to a numbers equation. If I pay whatever $1,000 more or $2,000 more, it lowers my monthly payment by this, and I get a payback of that amount in 48 months or 60 months or whatever the case may be. But again, like I said, 6.25%, which historically is still very good when you factor in a 40-year history of average mortgage rates. But 6.25% is quite a bit higher than the 4% rates that we were seeing in 2021 for a lot of mortgages when they started creeping up. And I myself had actually, refinanced and purchased some properties, our primary residence included, with rates fixed starting at 2.375%. So, by recent comparison, yes, 6.27% definitely is a little bit of a sticker shock, if you will. Now, the date of this publication here will be September 14th. And on this date, I'm actually doing a presentation this same day as this podcast launched to a real estate group. And my topic is really where the rate doesn't matter as much as some people think. I know some people get scared off with rates like, oh, geez, I'm at 4% and now went to 4.5 or 5 or whatever the case may be. It doesn't make sense to refinance. You should never refinance, yada, yada, yada. And I think that's unfortunately kind of a narrow point of view, and you really have to do the numbers and see if the numbers make sense to you. I've always reminded of a great quote by the real estate guys, Russell Gray. Do the math, and the math will tell you what to do. Now, for instance, I've talked about this in my newsletter, and obviously there's a lot of moving levers in place. But myself in 2023 or next year, I'm looking at refinancing two of my properties. Now, those properties are currently set at a 4.5% interest rate. And, I've kind of ran the numbers and I've kind of projected, maybe a 7% rate that I'll probably refinance to next year. And obviously, that's a 2.5% difference. And some of you might be like, well, John, why in the world are you looking to refinance? You're at 4.5%. Why in the world would you refinance to a higher rate? Well, I'm going to give a little quick rundown. Eventually, may have a video of this on my YouTube channel to kind of illustrate this, but I just want to kind of quick talk through the numbers before we get into the interview with Timothy. Now, by mid 2023, looking here, I will have about 16 and a half months left on the amortization table of the existing mortgages that are on the two properties that I'm looking at refinancing. There's also a reset period in there, which I kind of want to avoid. Now, some of you may be familiar with adjustable rates where, the term is locked for 5 years, and then after the 5 year term, then it resets to whatever the prime rate or maybe the Wall Street Journal rate is once a year after that. In this case, the way the loans are structured, and this is a non QM loan at the 10-year mark, which will actually be at 2030 if I still have those loans. Come that time, the rate resets to whatever I think it was the prime rate. I have to look for sure. So it's basically just one reset. So it might go to 4.5%, it might go to 7% anyways. Who knows what the rates are going to be in 2030? So it might be higher. Now, with that, looking at about mid 2023, the remaining combined mortgage balance will be about, I'm going to go conservatively here, round up per se, about 275,000. And just to give you context, my current principal and interest payment, not taxes, not insurance, HOA fees, anything like that, just the mortgage payment of principal and interest is about $2,000. Again, I'm rounding up to make for easy numbers. Now, like I mentioned, I'm looking to refinance to a 7% rate, but this will be a 30-year fixed rate. So that rate is fixed for 30 years. So if I keep that to term from that first date in 2023 all the way to that last date in 2053 when I have more gray hair than I have now, that payment's going to be fixed for that 30 years. And typically for a cash out refinance, as Timothy and I will go into, a lot of lenders are capping at 75% loan to value. Maybe there'll be an 80, 85% available. I'm not banking on that. So I'm just going to go conservatively at 75% loan to value. Now, I've kind of ran the numbers. I've talked to my broker, who's actually an appraiser who will probably do the appraisals on these two properties. And again, just kind of looked at comparable sales. Just had a recent sale of a triplex here in the month of August of 2022. I would say combined the properties value about 600,000, give or take combined. And again, 7% rate, 30-year fixed, cash out refi, loan to value at 75%. That will come to a $450,000 loan. And you can do the math on any mortgage calculator you find online. This will make my principal and interest payment jump from about $2,000 a month to $3,000 a month. Now, again, if you're still listening to this, you're like, well, geez, John, you're refinancing, you're going to a higher rate. You're increasing your monthly payment by $1,000, 50% increase. Are you on your medication? What the hell's wrong with you? So again, to quote Russell Gray, do the math and the math will tell you what to do. And this is where I'm going to kind of go into the numbers a little bit more thoroughly. So yes, my principal and interest payment will go up to about $3,000 a month, which is about a 50% jump. Now, the cash flow, even now from the properties, would easily cover that amount. So that, isn't a concern if you're looking at debt service coverage ratio. I'm not, upside down. I'm not negative cash flowing, anything like that. And like I said, this will easily cover the payments that is fixed for the next 30 years, locked in, regardless of what rates are doing, regardless of what the Fed's doing. Now, in 30 years, at even let's just say a 5% inflation rate, which is quite a bit lower than what we've been seeing here in 2022, a $3,000 payment will feel like only about $1,200 in 30 years. Again, if I, don't refinance again later on. And here I'm just using the rule of 72, which I've talked about in before in my blog and newsletter, at a relatively conservative 4% rental increase. I know some markets are seeing 10, 20, I've heard as high as 40% rent increases. I'm just going off a 4% rental increase. So if 2023, a property rents for $1,000 a month, fast forward a year later, a 4% increase comes to $1,040 per month and 4%, so on and so forth per year. At just a conservative 4% rental increase, my gross rents will have doubled in 18 years by 2041. And again, the payment's still fixed for that 30 years. So that payment is still $3,000 a month based on inflation, which I think Jason Hartman always says it's inflation-induced debt reduction. I'm sorry, Jason, if I mangled that a little bit, but basically inflation is whittling away at your fixed interest rate payments as time goes on. And like I said, just as a conservative 4% increase annually, probably on the conservative side with inflation that we're seeing between 5 and 10%, probably closer to 15% if you follow shadow stats, gross rents will have doubled in 18 years. That'll be by 2041. So that's just kind of how the numbers work for the kind of the outflows and inflows with the mortgage payment and then what I'm collecting in rent. Now, if you've been following the numbers here, and again, this is all based on what I'm giving audio via audio. I'll probably have a YouTube video on this later at a later time. But if you notice the numbers, I'm looking at a $450,000 cash out refinance loan. Once I pay back or pay off the current bank that holds the liens on the properties, they're getting a payout of about 275,000. That pays off their lien or their mortgage release on the properties. So 450 minus 275, that leaves $175,000 in cash, tax free. There's no taxes on debt from cash out refinances. Again, this is another trick that the wealthy use to grow and expand their wealth. And that $175,000 I'm planning on blowing on vacation of a lifetime. No, just kidding. I actually plan on putting that towards more rental properties. Now, I'm just assuming here that going off of 20% down payment, going off of conventional financing, 20% down payment that $175,000 would cover. Working backwards, if 175,000 equates to a 20% down payment across real estate, that comes to a purchase price of about $875,000 worth. Now, let's just assume here I could get, let's just say, 5 single family homes at 175,000 each, and that's actually pretty much in line. I'm actually looking through some spreadsheets and offerings I've got from various turnkey providers, Freedom down in Ohio that I've had in the podcast, episode 4, and also looking at Norada Real Estate with Marco Santorelli. I had him back on in February of 2022. Actually, this is going to be a returning guest here shortly. So, let's just look at conservatively here, $175,000 property times 5. Hey, that comes to the $875,000 of financing I can get based on the cash out refi. And again, this is all money. This is other people's money from cash out refinances and the bank's finances as well. If you wanted to look at it, I'm kind of essentially financing 100% of these 5 properties at $175,000 each. And again, this is assuming after all expenses have been paid, mortgage, insurance, taxes, etc. Let's just say for each $175,000 property, I am netting $250 a month net cash flow per property. So that comes to $1,250 a month in net cash flow across 5 properties. Again, this is pretty much in line with what I've been seeing in the turnkey industry as of late. So, quick recap, my mortgage debt from the refinance increased by $1,000. However, that is offset by $1,250 in new net cash flow. I'm also adding over $750,000 in cash flowing tax advantaged real estate at double-digit returns based on the 5 profit centers that Keith Weinhold of GRE talks about constantly on his podcast. And we'll still have a net new $250 a month or $3,000 a year of tax-free income, since this comes from real estate, which we talked about, depreciation and the tax advantages of real estate quite a bit on this podcast, as well as my YouTube channel. Now that, quick numbers here, $2,000 existing mortgage, refinancing those properties to get to a $3,000 new mortgage, obviously $1,000 more. However, that $1,000 more in mortgage payments from the refinance is being offset by $1,250 in net new cash flow from those 5 single family homes. Now, take out the increase of the $1,000 per month. Like I said, the properties that I'm refinancing already can cover this increase in mortgage debt, but just factoring in all the numbers offset, that comes to $250 a month in net new cash flow or $3,000 a year in tax-free income. And now, if you followed me for any amount of time, I've always had the tagline, financial freedom, one bill at a time. Well, that right there, looking at $3,000 annually, looking at my monthly expense, yearly expenditures, that would cover pretty much my annual tax preparation bills for our personal taxes, also our LLCs. That would add in also our Sam's Club membership and our family cell phone bills. So basically, by a refi, have the net new income, and I have 3 bills that are taken care of by passive income, and that's three more bills that I don't have to worry about paying through active income or income from a job or a 1099, for instance. Again, like I said, I'll probably have a YouTube video on this. Be sure to subscribe to my YouTube channel, hit the bell. Hopefully, I'll have this out by September 14th, but we'll see how things pan out here. But as a final note, speaking of YouTube channel, be sure to check out my YouTube channel as well this coming Saturday for my third episode of Screw the W-2, where Timothy Hero is also on. We talks about how he got into the mortgage business, how he got into lending, and how that's worked out for him, and why he just wasn't cut out for a typical 9 to 5. Had many jobs that he shares with us by the time he was 26 years old. So quite an interesting story, ties into today's podcast, but it was really a fun interview that I had with Timothy. So again, thanks for coming on. So with that, we'll get into today's podcast after a word from our sponsors. This week's podcast is brought to you by Focus Wealth Group. Do you know you need to get life insurance, but don't know where to start or how much to get? Have you heard of infinite banking, but not sure how it works? Reach out to Barry Brooksby and his team. Barry is not only a mentor, but a friend who has helped me for the past 6 years in my pursuit of cash flow and financial independence. Their mission is simple. They teach people how to make money and hold on to more money. Learn more and set up your free initial consultation at focuswealthgroup.com.
Are you tired of the 9 to 5 lifestyle? Do you want more freedom to do what you want, when you want it, without sacrificing your current income? Then this is the show for you. Every week, we dive into John's journey towards financial freedom and everything he has learned since 2014. Real estate investing, cryptocurrency, stocks, private lending, foreign residency, tax saving strategies, infinite banking, assets protection, and much more. Now, here is your host, the founder of the Wealth and Freedom Nexus, John Rickgarn.
Timothy, welcome back to the show. Hope all is well.
Thank you. Thank you for having me.
Yeah, you bet. Now, since the last time you were on, I mean, obviously we've seen a few changes in the market, but in your experience and your portfolio and what you've seen for rates, how have they changed in the last 6-7 months, as well as rates and terms?
So the past, I'd say 45 days, they finally cooled down.
Okay.
The whole inflation thing started, I believe, in October, and that's when things started shifting. We had a floor rate in the DSCR sector as low as 3.5%, whereas now that floor rate is 5.7.
Okay.
But from October up until about a month ago, it was just going up 25 basis points every 2 weeks or so.
Jeez.
And for the past 45 days, we've actually been seeing lenders lower rates.
Okay.
My highest rate lender peaked at about 7.8%.
Okay.
Right now, last month, that same 7.8% lender, they were around 7.5, and now they're 7.3.
Okay.
So they've actually calmed down about half a point in the past 45 days.
Okay.
As of today, my lowest rate lender, if you're talking 75% cash out, 1 point, decent credit, you're talking somewhere around 6.5 for my best rate lender.
Okay.
But overall, I'd say the sector is averaging between 6.8 to 7.2, somewhere in that range.
Okay. Which, if you were, grew up in the 80s and saw 12, 15, 18%, you're probably like jackpot. But if you're used to
it's a gold mine.
Yeah, I think the lowest rate I personally saw was 1.8%. It was on a conventional loan. I think there's a little bit of a buy down. So yeah, 1.8 versus, even 6, and is kind of a little bit of a acid burn.
Yeah, I think the lowest I saw, and I'm pretty sure it was a buy down as well, was like 2.3 or something like that.
So
that was last year conventional.
Okay. Now in the non-QM space, and I know this was kind of rare for many years. I had done some non-QMs in the past, and there were 20-year amortization with a 10-year rate reset, or 25-year amortization, but a 5-year balloon payment, or, some kind of a mixture of that. Is there, or are there still 30-year fixed available in the non-QM arena?
Yeah, actually all my loans are 30-year fixed right now.
Okay.
Um, that is something that I didn't necessarily anticipate going away when inflation started.
Okay.
But when COVID started, a lot of lenders were shifting to the 5/1 ARM only, no 30-year fixed.
Okay.
They didn't want to give you a decent rate in case COVID lasted 7 or 8 years and they were stuck with a low rate with you.
Sure.
They wanted to short term it. There's still the 5/1 ARM right now, but truthfully, I always tell people don't go it. It's literally like 15 basis points lower on the rate.
Okay.
There's no telling how long inflation's going to stick around. Right now, closing at 6.5. 6 years from now, what if your ARM loan expires and we're actually at 9 because inflation doesn't slow down? So it's better to lock it in permanently. And if in 5 years rates have turned around, you just refinance. It's not a big deal. It's what we're going to do on the ARM loan anyways.
Well, I think is industry average, if I remember correctly. So I mean, there's 15-year fixed, 20-year fixed, obviously 30-year fixed. But I think the average length of time for the average mortgage is like 7 years or so because people are always refinancing.
Yeah, I find that most people that come to me with their portfolio, and I always go through like how much debt do you have to see how much you're going to walk with.
Sure.
And then I always ask them, when did you refinance this? Because I don't want you to refinance if you're not walking with a lower rate or equity.
Right.
I'm finding most people refinance every 7 to 8 years.
Okay.
With the growth we've had in the past 24 months, I expect people now to refinance every 5 to 6 years just because appreciation has gone through the roof.
Yeah.
I mean, if you remember, like, I think it was maybe 2019, Seattle was the #1 market. And it was all over the news. Seattle went up like 12 or 13% market growth.
Yeah.
Now 12% is like an average number.
I know.
There's markets that have gone up like, I think 24% I saw.
So I think Tampa, I remember Tampa Bay area, Phoenix area, Salt Lake City. There's one other one I was remembering that was kind of like in the low 20%, year over year appreciation.
Yeah, Salt Lake City, Tampa, and Phoenix, those three seem to be consistent with it. They're not like a 1 year and then you don't hear from them. They seem to be 3 or 4 years in the top 10. But I do think with appreciation we've had in the past 2 years, people will be refinancing more. And that's assuming we have some growth still. I don't think we'll keep averaging these 20% numbers with the way the market slowed down. But I do anticipate every 5 or 6 years. And the only reason people are going to wait that long is to avoid the prepay penalty on their last finance.
Right. Makes sense. So now, as far as with, obviously some people just refinance, when there was a huge drop in the rates, like, whether it's conventional, non-QM, DSCR, whatever. Hey, I'm at 5%. I can refinance to 2.5 or 7 down to 3 or whatever the case may be. Obviously lower rates, lower monthly payment. But as far as like, investors like myself and many that I work with where, hey, I've had, 20% equity gain in my property, I want to access some of that equity. Is 75% loan to value still kind of the cap for cash out refinances, or has that changed?
Yeah, so I had an 80% cash out lender, but when inflation came knocking on the door, that they try to hold on to their 80% cash out.
Okay.
So inflation really started to affect the markets in October. By the end of November, they took it away.
Okay.
Just because they figured it was harder to sell those loans with those type of terms. Sell them on Wall Street, not to the borrower. Everybody will take 80% cash out.
Sure. Yeah, I suppose the days of 110% loan to value, no down payment, negative amortization loans from 2007 are long gone.
Everybody will dive at it. Yeah, I'm not seeing 80% cash out anymore. 80% rate in term. So if you want to get out of a hard money loan, that's 80% rate in term. But for cash out, 75.
Okay. Now, and you had alluded to this a little bit. I know every lender is a little bit different, but you had said obviously, your credit score plays a role into that. So if you have, I'm just throwing out numbers here, but say someone has a really bad credit score of, I don't know, 600, is then that more capped at like 65% loan to value? And then is like, I know a lot of lenders say once you hit 720, 740, whatever her credit score, it's not like you bump it up to 800 credit score, you're going to get a 0.5 point interest rate reduction or anything.
Right. So it's like you said, it depends on the lender. I do have lenders that'll actually go off the person with the highest credit score.
Okay.
So let's say you and your wife or you and a partner are on title, and you come to me and you're like, hey, man, I went through some things financially. I got a 580 credit score, but my wife's a 720. We will go off her 720 with some of my lenders.
Oh, interesting.
Yeah. And then I have lenders that take the average mid score of everybody.
Right. I think that's kind of
Um,
more the common
yeah,
criteria
yeah.
per se.
That reduces risk, but is also fair to you. So there's that approach. I did see when lenders started lowering rates in the past 45 days, some of them actually raised their minimum credit requirements.
Okay.
And this was to reduce risk. They said, okay, inflation has slowed down. It actually turned around this month.
Mm-hmm.
With that being said, we would like to lower rates, but we need to reduce our risk. So we
Okay.
can't just go from 7.5 to 7.2. If we're going to do that, we need to require a slightly higher credit score. Like
Okay.
one of my lenders had a minimum credit score requirement of 650. Now they're 680, but they've come down 60 basis points on the rate.
Oh, okay.
So, yeah, to protect their money, they'll give you better terms, but they need to make sure they're only lending to good borrowers.
Gotcha. So, and then as far as, someone comes in and maybe it's a portfolio loan or just a single property or whatever, and I'm just throwing out a number, say they can lock in a rate for 6.2%, let's say. From that time of locking in, how long is that locked in, and can you continue to pay to keep that locked in depending on what rates are doing?
Yeah, so that depends on the lender. Most lenders in the non-QM space, they don't lock until
Okay.
the end of the loan, like underwriting, which to me is almost irrelevant because most lenders in this industry will not lock until all the docs have been reviewed and appraisal has come back and a term sheet's been signed. At that point, you're 5 days from closing anyways.
Oh, okay. Gotcha.
But I do have a lender. It's ironically my quickest closing lender and my lowest rate lender who's offering rates like a whole 1% lower than the rest of the industry. So it's a gold mine all the way around.
Wow.
They actually lock in the very beginning and they hold it for 45 days.
Okay.
So all you got to do for them is pay for the appraisal, complete the app, and upload the docs. And usually you're rate locked about 48 hours into the process.
Okay.
In the non-QM, this private DSCR sector, I haven't found a lender that acts like conventional where you can pay money to hold the lock longer.
Sure. Okay.
45 days or that's it.
Okay.
And
Yeah, because
it's not even that long.
yeah, on the conventional side, actually a couple months ago, I was working with a first-time home buyer, and everything under the sun that could have delayed the closing occurred, and then some. I mean, the appraiser was kind of an idiot and had no time urgency, and then HUD was involved, and they're like, we'll get back to you in 72 hours, and then one thing after the other. So they went past the 60-day lock. I think they had to pay a couple of days to keep it there, and they were still at 5.2%. But sometimes I think on the conventional side, and this was a time that rates were starting to go up a little bit where, okay, I still want to lock in. It's not really the buyer's fault that the appraiser's taking their time or forgot the work orders and whatnot for an FHA loan. So
there's so much moving pieces in this game. You got the appraiser side, title, the borrower, the lender, the broker, the underwriter. Like there's so much. Then you got the insurance people. I mean, I always assume half of my pipeline will close, even though about 75% of whatever I put in the pipeline closes.
Okay.
Or falls through.
Sure.
Reason, credit, appraisal, whatever. Mentally, I prepare myself that half will fall through.
Mm-hmm.
So right now I have about a $5 million pipeline. In my head, I have a $2.5 million.
Gotcha. Okay.
Well, prepare yourself.
Yeah. Well, I think you shared a little off camera too. And, 2.5 years ago when COVID hit, and, there were some even in underwriting, and COVID hit, people weren't sure what's going to happen. And then it went from, I think you said 14 in the pipeline down to 0 almost overnight.
Yeah. I lost everything in COVID. My lender stopped lending. I got a call from my lender, one of my lenders. Most of my deals were with the same lender. That also doesn't help. They were with one lender. It was, I think, 14 loans. And he calls me and he's like, hey, with everything that's going on with this COVID thing, because at the time it was so new, it was referred to as the COVID thing.
Yep.
And he's like, don't get worried. I know half the industry shut down, but we're so confident the way we structured our business, we're actually giving $1,000 bonus to any client who closes a loan over $200,000 with us.
Wow.
So, that's good. He's like, yeah, that's how firm we are. We're positioned right. The very next day he called. He's like, yeah, we just shut down.
Oh boy. Okay.
Yeah.
So I'm guessing you didn't get that $1,000 bonus, I'm going to assume.
No.
This week's podcast is brought to you by Spartan Invest. Spartan currently manages hundreds of turnkey properties across Alabama and Tennessee, and is where I personally bought my first out-of-state turnkey property. In fact, I have 2 properties with them now, and both tenants just renewed for another 2 years. That should tell you the quality of their team and their due diligence. If you are a first-time investor or are looking to expand your real estate portfolio, check out SpartanInvest.com. Well, maybe just for quick and dirty math, and I know we had talked a little bit, and my plan is to do a large cash out refi in 2023. Kind of like you said, there's a lot of moving pieces where I have this loan that's got 12 years left on amortization, but there's prepayment penalties. So if I wait till April, another percentage of that prepayment is going to drop, so on and so forth. Realistically speaking, just kind of rough round numbers, someone has a $1 million portfolio, about 650,000 in debts on that portfolio, or 65% loan to value. We don't have to go high in the sky, but I don't know, let's say they got a 680, 700 credit score. If they were to come to you today, what type of rates and loan to value cash out refi would they be looking at?
For rates on portfolio, it's very hard to give an estimate because lenders typically discount the rate because how much business you're bringing to them.
Okay.
Here's an example. Yesterday morning, I quoted a $3 million portfolio. And with my lowest rate lender, I started to quote them as single assets in case he wanted to go that route, because sometimes people don't want to close them all as one for their own reason. And I quoted 3 or 4 of them, and they were all like 6.4, 6.5 individually. And as a portfolio, it was 6.2 for the same LTV.
Okay.
So it's really hard. My lowest rate lender, assuming you qualify something like that, where if we're saying, let's say 680, 690 credit score, 680 to 699 is the same tier.
Okay.
I'd say somewhere around 6.5, and you'd be capped at 70% until your credit goes over 700 for most lenders.
Okay.
But there's other lenders who, if you have another partner, they'll go off that partner's credit and right back to the 75% LTV.
Okay.
And then also not buying it down. You can buy it down all the way down to 5.7.
Gotcha. Okay. And then those buy downs, can you roll that into the loan if the equity or amount of equity is sufficient?
Yeah, it all comes out. The only time it doesn't come out is if it's a purchase or it's a rate and term refinance.
Gotcha.
On the cash out side, yeah.
Okay. Sounds good. And then as far as I know we had touched base with this a little bit the last time we were on the podcast, if someone comes to you and they have a 14 unit portfolio, but all 14 units are in Huntsville, Alabama, let's say, but then another person comes in, well, I have 14 units, but they're in Huntsville, Birmingham, Atlanta, Georgia, Memphis, Tennessee, Knoxville, Tennessee, Little Rock, Arkansas, et cetera, et cetera. I think you had said some lenders only like to go like a max of 3 or 2 or 3 geographic locations or LLCs and whatnot.
Right. So that is also one of my lenders won't close a portfolio as one loan if they're in separate states.
Okay.
All my other lenders will, as long as you have a title company that's licensed in all those states.
Okay.
You find title companies that are licensed in bordering states.
Okay.
If you invest in Jacksonville, it's at the tip of Florida.
Yep.
50% of title companies are also licensed in Georgia.
Gotcha.
Same thing with the Carolinas and that sort of thing. So finding a title company that can do all those states is the main thing.
Okay. Otherwise, like you said, you could do them as either individually or maybe 2 here, 1 here, 3 here, something.
Yeah. If you got 3 in Atlanta or 3 in Jacksonville and you can't find a title company to do both states, you can close the 3 in Atlanta together, the 3 in Jacksonville together, if that works for you.
Okay. Sounds good. Great. Now, obviously, the industry is always changing, and I know you had announced you just closed your 100th mortgage, I think as of an hour and a half on Facebook, if I recall. None of us have a crystal ball per se, but, barring, pandemics or civil wars or anything really out of line, what do you foresee as far as 2023, like stricter lending guidelines or more relaxed or?
I've been telling people since inflation started, it'll take at least two consistent inflation reports to come in good
Okay.
for me to be optimistic about the market. Last
Okay.
month or this month was our first one. And when
Sure.
I mean good, I don't mean on par with the estimated. I mean lower than last month's,
Right.
or at least year over year lower.
Sure.
Um, and I don't remember the numbers offhand. I think they were anticipating like 8.6 this month, and it came in at 8.3, if I'm not
Yeah, I
mistaken.
think it was it 9.1 for June and 8.5 for July, or 8 point something like that, which
Yeah, it was enough lower to really cause optimism. But
okay.
for me, 1 month doesn't do it. I need to see two or three to really be preaching that, hey, we're okay.
Gotcha.
Um, but as of now, keep in mind these lenders, they're closing 700-800 million a year in mortgages, and this is a new sector. The
Wow.
non-QM sector was officially like 2013, 2014 when it really started, and there's companies even doing 2 billion a year in mortgages, and
Jeez.
they pay six figures to people to make the rates, and these people who make the rates, they understand the economy 10 times more than me. And if
Okay.
they lowered rates in the past 45 days, not once, but twice, that's a positive sign.
Okay.
So assuming we can get another inflation report lower than expected, even two more, that'll be three straight, then things will be looking good.
Okay. Sounds good. And I know you kind of alluded to this earlier, and maybe things have changed since we last spoke in February. But one, if anyone's interested in a portfolio loan refinance, cash out refinance, what's the best way to reach out to you? But then also maybe just to help, so no one wastes your time. Are there any specific areas or states that you can't lend in currently?
Yeah, so I can do 45 states.
Okay.
I cannot do North Dakota, South Dakota, Utah, Nevada, or Alaska.
Okay.
Um, the rest of the states I can do.
Okay.
Um, in terms of how to reach me, my website's timothyhero.com, just my name. So anybody who does that, hopefully they put you as a referral.
All right. Perfect.
That they heard about me through here. And then my email for any questions that aren't on the FAQ is th@timothyhero.com.
Okay. And then as far as I'm very familiar with conventional space where you need 2 years of tax returns, 60 days of pay stubs, DNA and blood samples and hair samples and your birth certificate. What all documents should a prospective borrower come to you with, so that they're one, it makes it easier on you, but then also streamlines the process?
So the main things is, of course, we don't want DTI. I have people who are like, this is a low doc loan, right? And I'm like, yeah. They're like, okay, here's my income stuff, and you don't need anything else, right? And I'm like, I don't even need that. Like,
Okay.
you've already sent more than I need. So a list of docs, and this is pretty much the same amongst all lenders.
Okay.
99% of the industry requires you to close in an LLC now.
Okay.
So we need an EIN page, we need the operating agreement, and we need the articles of incorporation, or some states call it certificate of formation.
Okay.
Which is just a doc stating when you created the LLC and everything. So we need those three LLC docs. We need a lease. If it's lease, it does not have to be leased with most of my lenders. It can be vacant.
Okay.
ID, 2 months bank statements. This is not for income. This is just to showcase reserves.
Okay.
To verify accounting and routing number for automatic payments to come out every month.
Gotcha.
Or you can do a voided check for that route. So those are the main things. Underwriter will often reach out, depending on the lender we go with. Underwriters will often reach out to title and insurance to handle that direct, so the borrower doesn't have to get in that.
Okay.
That's very dependent on which underwriter you get, of course. Some don't mind the extra leg work, and some state, it's your job. So
Sure.
but those are the main gist. There's no DTI. There's none of that.
Okay. Sounds good. All right. Well, yeah, I think hopefully the whole non-QM, DSCR, or debt service coverage ratio kind of keeps picking up, obviously for you, but then also the industry in general. I think the whole Dodd-Frank went a little overboard on the conventional lending side, and hopefully this kind of eases up a little bit.
Yeah, last year when they came out with that 7% rule where conventional mortgages, banks cannot lend more than 7% of their capital on investment properties, that's when our industry was really skyrocketing. Because I had people coming to me I had one guy who owns a management company. He makes almost $1 million a year. I think he said 800 or something.
Wow.
He has like an 810 credit score. He has a portfolio. I don't remember the value, but it's low millions, 4 million or so.
Okay.
And he couldn't even refinance the equity out because of the 7% rule.
Oh, geez.
So, and then there's conventional lenders that he could, but they were charging like 2.5 points, and it wasn't even a buy down. It was just standard.
Oh, geez.
Yeah. So thank you to whoever made that rule, because you made the DSCR sector just blow up even more.
Yeah. Well,
Thank you for listening. Be sure to share, rate, review, and subscribe on your favorite podcast platform. For more updates, check out www.wealthandfreedomnexus.com.
All right, well,
Remember, nothing on this show should be considered tax, legal, investment, or professional advice. This show is produced solely for educational and informational purposes. Please consult an appropriate and licensed tax, legal, real estate, or business professional for specific advice for your situation. For distribution or publication rights or media interviews, please contact the host.